All right, let's jump straight into this explainer. Today, we're dissecting an absolute financial thriller that kicked off in May 2026. Now, this isn't just your standard market rumor mill. We're going to treat raw, hard financial data as forensic evidence to unpack a move so insanely bold, it literally left Wall Street speechless. We are talking about GameStop. Yes, the nostalgic video game retailer launching a hostile, unsolicited $55.5 billion bid to acquire the global e-commerce pioneer eBay. You heard that right. It's a massive, unprecedented whale hunt, and we're going to break down exactly how it happened. To really grasp the audacity here, you have to picture the ultimate David versus Goliath setup. Back in early May 2026, GameStop was sitting at a market capitalization of roughly $12 billion. Not bad, right? But then they set their sights on a hostile takeover of eBay, an absolute behemoth rocking a $46 billion market cap. It's a much smaller brick-and-mortar retail brand attempting to completely swallow a global tech giant that's nearly 4 times its size. To pretty much anyone looking casually at the situation, the math just doesn't seem to add up. But GameStop didn't just come with big talk. They came to the table with a very specific, hyper-aggressive offer. They completely shocked the market with a massive $125 per share proposal. And the structure is super fascinating, a 50-50 split of cash and newly issued GameStop common stock, totaling that massive $55.5 billion. But here is the kicker, a real touch of corporate espionage. GameStop didn't just knock on the front door. They revealed they had already quietly leveraged derivatives in stock to build a secret 5% toehold position in eBay long before they ever made this bid public. Okay, let's move into part 1, the smoking gun data, and exactly why GameStop CEO Ryan Cohen is out here calling eBay mismanaged. See, GameStop didn't just float this massive bid on a whim. The CEO went on national television and outright pointed to his staggering efficiency gap to prove his point. Let's talk about selling, general, and administrative expenses, or SG&A, for 2025. Amazon runs this incredibly lean operation, spending just 8.1% of revenue on overhead. And eBay? Well, they are sitting at a massive 32.3%. You have to ask yourself, why is a pure digital marketplace burning through over 32 cents of every single dollar just on overhead and marketing? It's wild. But here is the true margin miracle, the actual secret sauce that justifies this entire hostile bid. Amazon operates at a 50.3% gross margin, which is solid. eBay, though, because they operate as a pure digital marketplace and don't take on the cost of the actual physical goods, they secure an elite 71.5% gross margin. They are absolutely crushing Amazon at the top of the income statement. And that margin sets up the whole asset-light argument perfectly. Think about capital expenditure, or CapEx, basically what a company spends on physical assets. In 2025, Amazon sank a mind-numbing $128.3 billion into warehouses, server farms, and giant delivery fleets. They carry a massive logistical burden. eBay, on the other hand, spent a tiny $0.5 billion. Why? Because the sellers handle all the shipping. eBay is virtually weightless compared to Amazon's heavy footprint. So when you put all that data together, a crystal-clear narrative emerges. It's the leaky bucket metaphor. eBay is generating these elite, top-tier profits with their 71% gross margins, completely free from massive physical infrastructure costs. But, and it's a big but, they are bleeding cash through bloated management, administrative, and marketing costs long before those profits ever reach the bottom line. It is a high-margin cash cow, but that bucket has a massive 32% leak. Which brings us to part 2, the lean extraction plan, or how GameStop plans to strip eBay down to its absolute core. GameStop isn't just buying eBay to hold it, they want to surgically fix that leak. They are proposing a ruthless value extraction strategy designed to achieve $2 billion in annualized cost reductions. And they want to do it fast, within just 12 months. The plan relies on 3 major aggressive cuts: slashing $1.2 billion from marketing, consolidating back-office functions to save $500 million in G&A, and then trimming $300 million from experimental R&D to force eBay to focus entirely on its core marketplace. But look, you can't just cut your way to long-term growth, right? You need actual operational synergy. And this is where we hit the most controversial part of the plan: a bold operational pivot to keep the brands intertwined. The vision is to take 1,600 brick-and-mortar GameStop stores across the country and transform them into physical authentication and intake hubs for eBay sellers. Imagine strolling into your local strip mall GameStop, handing over a rare collectible, having it authenticated right there on the spot, and instantly listed onto eBay's global network. It's totally out of the box. If they pull this off, if that $2 billion in bloat is successfully cut and those physical stores start driving massive new marketplace inventory, the financial payoff is absolutely staggering. The goal of this lean transformation is to nearly double eBay's earnings per share. We're talking taking EPS from $4.26 all the way up to a projected $7.79. I mean, that is exactly the kind of pitch designed to make any value investor's eyes light up. All right, part 3, the market reality check. Time to address the $16 billion elephant in the room. Because let's be real, while an operational turnaround might look phenomenal on a spreadsheet, Wall Street isn't exactly buying the dream just yet. As soon as you pivot to the reality of the market, things get harsh. GameStop is staring down a gaping $15 to $16 billion funding shortfall. Their combined cash, debt, and stock leaves them miles away from actually covering that $55.5 billion offer. To bridge that gap, they'd likely have to issue an unprecedented amount of new stock, which is a huge threat of massive dilution for current shareholders. And as we all know, the market despises uncertainty, and it absolutely hates stock dilution. The sheer logistical nightmare of this plan, combined with a noticeable lack of traditional institutional backing, caused GameStop's own stock to immediately tank 10% right after the CEO made his public pitch. Critics are extremely vocal here, pointing out that running a declining physical retail chain does not magically qualify a leadership team to take over a highly complex global e-commerce powerhouse. Which leads us to part 4, visionary or meme stock, the ultimate endgame. This entire saga leaves the financial world completely split down the middle. Data-driven analysts look at that crazy SG&A blow and say, yeah, eBay is absolutely right for disruption. But market realists, they just dismiss the whole thing as an over-leveraged fantasy. So we're left looking at 2 extremely different realities: a nostalgic, strip mall video game shop on one hand, and a hybridized, high-margin e-commerce intake center of the future on the other. So what does this all mean for us? The numbers tell a story of a trapped cash cow, but the market tells a story of a funding nightmare. Is Ryan Cohen a visionary unlocking hidden billions? Or is this the ultimate meme stock endgame that flies too close to the sun? Is the 71% margin enough to save this deal? Let us know in the comments. Thanks so much for joining me for this explainer, and I'll catch you in the next one.